Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our weekly podcast, my guests and I will cover everything under the sun in regards to real estate, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets will be covered here. We're not, your ordinary real estate show where we're basically going to sit here and tell you what a wonderful time it is to buy. We're going to give you more of a detailed analysis of what's transpiring and how you can potentially take advantage of the opportunities that are out there for the people that are able to take advantage of them. Joining me as my guest today is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been quoted in the media in numerous plays, the Wall Street Journal, CNN Money, Chicago Tribune, Smart Money, Forbes, AOL, and the list goes on and on. Louis, how you doing today, buddy?
Doing grand, Ryan, and you?
I'm doing well. It was interesting. We spoke was last Friday, right, when we were having a discussion, right, as basically they were releasing employment numbers and whatnot, and rates just took a tumble. We were discussing in the middle of the show, remember what was going to happen, and then as that day went on after our podcast was over, it got, just progressively worse the rest of the day. We almost lost about 200 basis points, which was almost the equivalent to a half to three-quarters in rate in one day, which is exactly pretty much what we warned the listeners of our podcast about. It went downhill fast, and interestingly enough, I got absolutely bombarded with calls over the weekend and throughout this whole week about, I didn't think that this was possible. I thought everything, interest rates were going to stay low, home prices were obviously rising. What's the deal here? And it's interesting only because, it took the news media to just say, oh, interest rates rise a half to three-quarters of a percent. But yet we were paying attention knowing that this was something that could potentially happen. And now we come to this week where Bernanke came back out and, like a politician would, essentially flip-flopped on what he had said as far as discontinuing QE3, where now they're going to continue it for some time. And he actually, believe it or not, Ben Bernanke agreed with us, Louis, that the employment reports aren't necessarily that accurate, which I was kind of shocked to see that, where he's basically saying that things aren't as good as they should be, but he really doesn't have a choice because I think that's the only leg he has to stand on is the employment situation as the culprit for flip-flopping. Would you agree with that?
I agree 100%. And if you remember, when the report came out, we called exactly how the market would interpret it. There was a large non-farm payroll number that people would say there, evidence that the economy is improving, and now the Fed is going to taper. But you and I immediately knew that behind those numbers, there had to be an enormous amount of part-time workers that really would indicate that the health of the employment market wasn't that strong. And if you think about it, until Bernanke came out and spoke and mentioned that he wasn't satisfied with the underemployment in the employment market, with the low labor participation rate, the markets were still interpreting that Friday jobs report as positive. He basically said he's not satisfied with the employment situation. And if you remember, the Fed has that dual mandate where they're somehow responsible for maximum employment. Now, the reason he did what he did, he saw when he started talking tapering, the interest rates shot up. And he needed a way to bring them back down. So this is the way he brings them back down. What's interesting, though, is if the reason we have underemployment is, for example, because of Obamacare, monetary policy, quantitative easing, tapering, not tapering, isn't going to change that one bit. And that's kind of ridiculous, where he's basically saying that we have a problem with employment, a lot of part-time workers. QE isn't going to fix that. But we're in a situation now where basically the market is driven by what one guy says, what one guy might do, what one guy might say, what they might do and what they might not do. And that's where we are now. And I think eventually, Ryan, I want to get your thoughts, they're going to have to maintain some credibility, do some type of taper. And then, of course, they'll have things in their back pocket to speed it back up. But what's interesting about this entire scenario with tapering in the last 3 or 4 months is all the other QEs, we've always had a tapering of QEs. They've all ended, and then they start up again. So I don't know why people are all bent out of shape that somehow the Fed might pull back. They'll be back again. If they pull back and they see the economy is not recovering, because it's not, they'll just launch another round.
Right. Yeah. And it's interesting because, everybody is watching gold and silver prices fall off the face of the earth, and everybody was pumping the stock market up, to levels that are essentially absurd in my opinion. And now, after basically Bernanke came back out and flip-flopped, now all the people that were very bullish on gold are like, oh, yeah, we knew he wasn't going to stop the QE, so this is definitely good for us, the continuous of printing money. So now, I feel like gold prices are going to start to rise back up. And, it was so much of a farce. You and I discussed, literally interest rates can't go up but so much. Our government can't afford to pay the interest payments on their debt if they did. So
the only way they can afford to go up is if the economy was improving. But when interest rates spiked the way they did, they didn't spike because all of a sudden the economy rose. They spiked because Bernanke opened his mouth and said he might pull back on the QE. Interest rates are driven not by the economy, they're driven by whether the Fed's buying or not. And if the Fed's not buying bonds, rates are going to go up. It has nothing to do with whether the economy is doing well or not.
Yeah, I think that's the key component there. So for everybody out there that's in the real estate market right now, whether you're looking to buy or sell your home, and you're trying to figure out, okay, well, what do I pay attention to? What are the key indicators for me to figure out what's going on with the interest rates? As I said before, normally I would say that you could look at economic indicators and the economic calendar, and I could tell you, okay, what's probably going to happen if a report comes in positively or negatively. But now it's almost solely based on what the Fed wants to do and say, which is an artificial market that they've created. So really, when I'm looking at things, I almost honestly have to figure out how the Fed is going to interpret every bit of piece of information that they get and how they're going to twist and contort it and turn it into the story that's then going to be pushed out to Wall Street, because Wall Street's going to look at every move the Fed makes and figure out whether they're going to pull back their money or whether they're not. And to be honest, I don't see this changing for the next 3-4 years, Louis. They can go back and forth, but long term, you and I both said, and it just seems like our long term is going to turn into probably some sort of 6-year
lifetime,
right, or a lifetime, right? It's going to go on forever, but they cannot have interest rates rise up above 5%. I'm pretty much convinced of that. And when we just saw that huge increase over the last week, now right back, Bernanke getting things back in line, pushing them back into the 4.5 range. I pulled up our average interest rates, overnight rates. So the 30-year fixed rate now, average interest rate is around 4.52%. Last week it was averaging about 4.4%. But what's really interesting, at the end of the week on Friday, when we had that almost 200 basis point swing in price and interest rates went up near 5%, now they've kind of, tapered back into that 4.5% range. But I do want to warn you that, the Fed's buying out essentially 75% of all mortgage-backed securities out there. So the other 20 to 30% that's being bought up by, basically private capital is such a small amount, right? But with the Fed basically saying that they're going to continue to purchase mortgage-backed securities, there's still going to be some private money that would continue to buy up the rest of that, which is, I think, pushing the interest rates back down. The other 20 to 30% last week, when they said the Fed's going to taper off, they started dumping their money back out of mortgage-backed securities.
And not just that, Ryan. You saw when their interest rates spiked during those 2 weeks, just before they kind of came back down the last 2 days after Bernanke spoke, the number of mortgage applications were estimated to have dropped, depending on who's doing, between 10 and 15%. Now, there are those those economic pundits who've been saying all along, and I don't get how they come up with this, but they say, rising interest rates, don't fear the taper, not a problem, because rising interest rates show that the economy is improving and the economy is recovering, and the market will be able to handle interest rates. And that's nonsense because we saw when rates went higher, mortgage applications dropped. And that's important to the Fed because the Fed is counting on the housing market, which is kind of a ridiculous concept, to drive the overall economy. It's really the reverse. People moving in and out of houses doesn't create a solid economy. If the economy was doing well, housing would do well, and that would be reflective of the economy. So what's happening right now is you have all of these what I call recovery addicts, not recovering addicts, but recovery addicts who every piece of data they see, they think that means the economy is recovering. Rates go higher, it's because the economy is recovering, not because Bernanke is threatening to stop buying bonds. Part-time work, not a problem. People still have jobs, still a solid jobs report. And we saw that on Friday. If you looked at the bulk of the headlines, when the jobs report came out, and you didn't have to read past the first couple of lines of the release to see that all those jobs were part-time, but the media went into full recovery mode and started talking about a solid jobs report and so on. And it really was the narrative until Bernanke said just the other day that he's not satisfied with the employment situation. So you have these recovery addicts who are constantly saying that every piece of economic information or data that they get is a sign that the economy is recovering. They want to justify Fed policy. And it's really hard to justify because I really don't see a way out of this, because now that Bernanke has kind of said, well, we're going to be accommodative for a long period of time. What he means by that, Ryan, doesn't mean they're going to continue to buy mortgage-backed securities and they're going to continue to buy U.S. Treasuries. He has said that he's not going to sell mortgage-backed securities. What I think he means is that he's going to try to keep interest rates low just by keeping them, the fixed rate low. That's not going to work because just because he says they're low, the market, without Fed intervention buying bonds, is going to make the demand for bonds plummet and the yields are going to rise. And at that point, they're going to have to step back in. You know what they'll do? Maybe they won't call it QE anymore. They'll come up with another name to get everybody focused on it, and they'll continue to somehow prop up the market, because the only hope they have for this economy to do well, and it's misguided, is somehow to boost the housing market and hope to create some kind of inflation that'll create jobs, and also that'll help the banks because they'll have low cost of interest, and it'll help the government because it'll keep their cost of debt service low. And so they're going to have to find an excuse to keep QE going.
Oh, absolutely. What's interesting to me is that the mortgage application number, right, I think is a really good indicator of how our economy is doing, because we don't see tons and tons of purchase applications. About 70% of the mortgage applications were refinance applications.
Well, they're gone now.
Right. And now those are gone, right? So that 70% might turn into 20% now, okay? Well, do you think we're going to have an uptick of some, 50, 60% in purchases with rising interest rates? Of course not.
No, but you know what the recovery addicts will point to is how many homes were sold in June. But forgetting that those homes were applied for mortgages months ago when interest rates were at record lows.
Absolutely. And I mean, how many people are currently still looking to get into a contract right now that have been looking for the last 6 months when interest rates were low? They're having to go back and get requalified, right? Because they may not be able to afford the home that they were looking for 6 months ago.
Right.
Or they can still afford it, but their payment's now $200 more than what they planned on spending. So interesting, because there's an article in Reuters this morning because consumer sentiment came out and obviously edged down between 83.9 from 84.1. And the headline reads, worries about rising interest rates and falling stock prices hit U.S. consumer sentiment in early July, while other data showed a firm rise in wholesale prices that could make the U.S. Federal Reserve more comfortable reducing its monetary stimulus. That's a bunch of crap. That's a bunch of crap. Really. Obviously, when interest rates rise, nobody's going to be happy about it, right? Nobody's going to be happy about rising interest rates, but
or rising costs. Like, people want inflation. I don't understand that. They want to pay more for gas. They want to pay more for eggs. They want to pay more for food.
Yeah, and I think that the Fed finally was like, they're looking at those mortgage application numbers just like I just said and realized that 70% are refinances. Then they see interest rates shoot up to 5%, and they're like, holy crap, we just completely screwed up the real estate market all over again. You know what I mean?
Which is the only way of boosting the economy, that and the stock market. Now, the stock market, Ryan, has kind of shrugged this whole thing off. The stock market has convinced itself it's the only game in town.
Yeah, it's unbelievable to me. I mean, we have the Dow right now. It's down 10 points right now, but it's overall at 16,450. I mean, that's crazy.
Now, if you want to look at an indicator, look at UPS today. They should be a general bellwether as to economic activity in the United States, and they gave guidance substantially lower. So they know that they're going to have fewer shipments in the coming months.
Right.
Which means the economy is not recovering. You had a GDP number that was in the first quarter that was under 2%. You have a lack of export growth. You have negative exports in the trade balance. So the second quarter is not going to be that good, and it's on a downward trajectory. It's not like it's starting the recovery. We've been hearing this since 2009. Green shoots in the recovery in 2009. I think 2010 was recovery summer. You've had these recovery addicts constantly beating the drum and saying that we're having a better economy when really what we've had is a mini real estate boomlet for like 6 months this year, and we've had a slew of part-time jobs created. We have not had any type of sustained or significant economic recovery, despite the fact that the Fed has done QE programs totaling, I think, $2.2 or $2.3 trillion.
Yeah, and I think it's interesting. You and I had spoke about, many of the employers were already preparing for Obamacare to take place in 2014. So they were preparing themselves for that. And now that it got pushed back another year, I can't remember the name of the company. It was a relatively big company. They had said, you know what, it's too late.
Challenger and Gray, is it?
Yeah, it was something like that. But they're saying, it's too late for them to come out and extend it now. We've already made the moves for based on next year.
Planning has already been done.
Exactly. They're not going to go
back. They have to undo it anyway at this time next year.
Absolutely. Yep, exactly. So they're going to keep their plan in place. They're going to probably hire double the amount of workers, all part-time, versus taking and hiring full-time employees, which they'd have to pay benefits to. I mean, it's inevitably our economy is, to me, it's completely based around the Fed's ability to prop up real estate. Because if there wasn't real estate, what else would there be, Louis? I mean, right. People that have their equity positions going up over the last year or two, they actually now can potentially refinance, pull some money out, take a home equity line out to put on a new deck, to do an addition. You know what I mean? Like, that's all that there really is.
But, Brian, there was an article in MarketWatch saying that the one type of loan that consumers are falling further behind in and delinquent are home equity loans, which shows that people are using home equity loans again as a source of income to live beyond their means, and that's why they're defaulting on those loans. That's been made available again. Now that people are coming out from under water on their home equity, are starting to take the loans out again.
And what's crazy, even more crazy about that, Louis, is that, home equity loans typically on their primary residence, they're maybe like prime plus 1 or prime plus 2, you know what I mean? So
that's why they're taking. They're better than credit cards.
Right, they're like 4 or 5%, and they're using that, like you said, to basically help with additional funds when they need them. You're borrowing against your home. It's another debt, and you can borrow responsibly, but when we start to get this appreciating market in the DC metro area, I will tell you, it's even with the levels that we've had them rise to, 10, 15, 20% increases in some areas year over year. It's, regardless, I think 5% and less interest rates, it's still going to move only because we have a shortage of homes. I think that it's going to take years and years and years for us to actually turn around what took place, 6-7 years ago, because there's still, I would say, probably 30% of the people are still going to be underwater. You know what I mean? Everybody forgets that even though the market has turned back, that there's still tons and tons of people that are still buried.
That's because the volume of sales was highest when prices were highest.
100%. And they bought their house for $300, and it went down to $200. Now it's back up to $250. They still haven't even gotten close to recouping what they paid for it, and it's going to be difficult for them to get to the break-even point. I mean, we'd have to have interest rates be in the level of that 3.5% range in order for us to see that huge jump in equity positions like we had back 6-7 years ago, and that hasn't happened. Now they've kind of caught on. Obviously, Wall Street's starting to see what's taking place. The Fed's continue to manipulate interest rates, and I don't see interest rates going lower than 4% again. They might.
And Ryan, what happens if, which I predict will, in the next 6 months, people that have emerged from being underwater have taken out home equity loans, refinance, and now the home price goes back down to where they're underwater again? That's another disaster for the economy.
Yeah, and I think we had mentioned this before, Louis. It's history repeating itself in less than 10 years, right?
This is basically, I don't think this is a boomlet as far as I'm concerned, or a bubblet. I think it's concentrated in some of the hot areas that were always hot, like San Francisco, D.C. Metro, and in other areas that were the original, where the places were cheap, like in Florida or Las Vegas, Phoenix. They've gone back up too. And so you're seeing exactly the same type of behaviors, the same type of price appreciation, the same type of mini mania, but it's going to end very quickly. And I think what the Fed saw, that it had to almost, I think if he didn't start talking just the other day about, wait a minute, we're going to be highly accommodated, we're not satisfied with employment, we're going to keep interest rates low, the rates would have gotten out of hand. I think in a couple of weeks, the mortgage rate could have been 5.5% for the 30-year.
Oh, so, I agree with that 100%, because the way it was headed just on Friday, as much ground as we lost, if they didn't do some sort of, cleanup control there, it would have got out of hand. It could have gone 5.5%, 6% that quick. Because
let me ask you a question. I don't track the 30-year mortgage the way you do. I keep on my screen the 30-year and the 10-year Treasury. I saw that those rates, after Bernanke spoke, the interest rates went down, but I think their 30-year mortgage rate went up despite that. Is that correct, or did I misread that?
Which index were you saying was going down?
I look at the 10-year and the 30-year note.
Okay.
And after Bernanke spoke, the interest rates went back down.
Today?
But the 30-year mortgage rate, which is different than the 30-year Treasury, I believe continued to creep higher.
Yeah, well, what happens is there's different coupons, right? So you have the Fannie Mae 30-year at 4%, right? Then you have the Fannie Mae 30-year at 4.5% coupon. So there could be subtle differences in the different coupon rates, right? So it's like, I remember last week it was something like the Fannie Mae 3.5 coupon was going wild, but the Fannie Mae 4% coupon was staying relatively stagnant. You know what I mean? So it just depends on which one you're looking at. You really have to actually look at the mortgage-backed securities table, which breaks down all the yields for all the different coupon rates. But it is possible for that to happen. And the 10-year is typically a good bellwether for what's going on in general with interest rates. But sometimes they can move in opposite directions. It can happen. I know that the 10-year has been all over the place lately, but it's
and sharply up and sharply down.
Yeah, it does. It moves very quickly, because I think it was up to 2.7 and then back down to like 2.52.
Right.
And right now, basically from this morning, interest rates are probably they're up about maybe 3 to 10 basis points. There's no major moves today, even after the PPI came back a little hotter than expected, I believe. Did you see that report today, Louis?
I did, and the recovery addicts will just dismiss that. Well, gas price, that's temporary, it's transitory, it's not a big deal. It is a big deal. But right. They're not going to, and the thing is, they can spin that into being good news. Okay, so Bernanke has his inflation, which is good in a perverse way, and therefore he can start to taper because he knows exactly what he's doing. The economy is improving. It's reflected in the number of jobs we have, and he's getting his inflation, so there are going to be even more jobs. And if the economy is improving, interest rates will go higher, but that's okay. The housing market can handle it. That's exactly the misguided narrative that we keep hearing. Everything I just said is 100% the reverse.
Right.
It's untrue that inflation is good, part-time jobs are good, and higher interest rates are good.
Yeah, I mean, and it's just common sense that tells us that, Louis. I mean, part-time jobs makes it damn near impossible to qualify for mortgages, okay? Because, number one, most time you're going to need multiple part-time jobs, and then as I've mentioned before on the show, you're going to need 2-year history with each of those part-time jobs. So, okay, it's going to be very difficult to qualify for a mortgage. So then we have rising interest rates. Rising interest rates makes it even more difficult to get qualified because now you have to make more money to qualify for the same loan than you did a month ago, right? And
then if you have to pay more for gas and other items on the less amount of dollars that you have, how are you better off? And how are you in a better position to apply for a mortgage or to do anything economically? And put aside, you're just assuming that you're fine with that part-time job. From a career perspective, you're not. You're not getting the same type of career potential and advancement when you hold 1 or 2 part-time jobs for a number of years.
Right.
All you're doing is being able to keep the lights on, and that's admirable if you can do it, but it's not going to put you in a position where 5 or 10 years from now you're going to be making substantially more money.
Right, yeah. It's interesting because I had pulled a graph earlier, and I wanted to say that I was saying, like, let's say last year interest rates were about 3.5% on a $200,000 price, and let's just assume that they've increased in the D.C. metro area in certain areas by 10%. So last year at $200,000 at 3.5%, you're paying roughly $898 a month, principal and interest. Now this year, your house went up 10%, so you're now at a $220 sales price. If you were to buy now at let's just say a 4.5% interest rate, which is pretty much what they're saying the average is on the 30-year, it's $1,114. So your difference year over year is almost $220 a month difference right there. I don't see wages increasing at that level. Do you, Louis?
Absolutely not. Absolutely not. And by the way, if you are a part-time worker, your wages aren't going to increase because you have less bargaining positions than you would if you're a full-time worker, because by the very nature, a part-time worker is more fungible.
Right.
I mean, your biggest bargaining position as a part-time worker doing an excellent job is put me full-time.
Yeah. It's interesting because there's a lot of real estate talking heads out there that are saying that, there's no way that this is another sort of housing bubble and that this, that these trends can continue. We can continue to have rising prices. Obviously, they're saying that mortgages are still much cheaper than renting. While I do agree with that, because I think that interest rates, as long as they say sub 5%, it still is a better option to buy if you can get a loan. And I think that that's pretty much the biggest hang-up that most people have, or get a loan for the house that you ultimately want to buy. Like, so if you're looking to move your family from a townhome to a single-family home, but you need X amount of bedrooms, bathrooms, and square footage, but you can't really get a loan for that, then it doesn't really necessarily make sense for you to move. And I think that many people are thinking that, well, if I just stay in this home another year or two, I think that my home will continue to appreciate, so I'll have enough money to put down as a down payment on another house. I mean, there's a lot of factors that come into play here, Louis, that we're not living in a perfect world right now. And with the Fed manipulating interest rates as they are, it's really hard for anybody to plan long-term what they're going to do.
Right, and what that does, it gives people the false signals. And I think you saw a lot of people rush into buying houses in the past few months, and probably still doing so. There's a segment of the population that thinks they don't want to get priced out by interest rates, so they're lining up to try to get qualified for a mortgage now before rates go higher.
Yeah, and I mean, don't get me wrong. I tell everybody that I come in contact with that if they have the means and ability to qualify for a low fixed rate mortgage right now and to make their move up to, maybe even if they can rent out their current home and buy another one, if they have the income and down payment to support those things, I think that they should do that. Only because I think long-term interest rates are going to spiral out of control. I think rents are going to rise very rapidly. I think inflation long-term, the outlook of that, Louis, you and I have discussed this ad nauseum, which basically we feel like it's just going to shoot through the roof at some point. Now, who knows what the timeline for that is, and you and I have predicted wrong in previous times before, so it could happen, next year, the year after, it could be 5 years. But if you protect yourself by locking in a low fixed rate, now, I'm not saying take out a low fixed rate and then turn around and refinance it 5, 6, 7 years from now and go into a higher interest rate of 7% because you need to take cash out of your house. That's not a smart move. You know what I mean? And I think that what has happened over the last 7, 8, 9, 10 years is it's become somewhat of a predictable real estate market where when assets rise and real estate prices rise, the first thing people want to do is snatch up the equity in their house and spend that money. That's what typically happens. Nobody's saying, oh, that's great, I've got more equity in my property. Eventually, if I, do want to sell down the road, then, I actually have more equity there. We're this economy, we just want to keep consuming and consuming and consuming, but ultimately that leads to higher mortgage payments, and that's what puts us back into positions where, if somebody were to lose their job or lose one of their part-time jobs now, they might not be able to afford to make the payment.
And Ron, you remember, or your dad will remember, one of the key selling points of buying a home was it was forced savings. It wasn't equity appreciation. In other words, what you just described is you buy a house 10 years ago, you put your money in, you maintain the home, the value maintains, maybe it goes up a bit. That's money that's now yours and you've saved it. But the mentality now is, how much equity can I extract, or when can I sell and make a profit?
Yeah, and I mean, it even has people selling now,
yes,
just to get the cash out of their house, right? Because they.
Well, you know why? Because they've seen this. It's almost like this is a gift horse. In other words, people bought a house in 2001 or 2. They saw the price go to bubble rates, and they didn't sell, even though they're perfectly happy living in their house. Now, like for example, in San Francisco, prices are actually higher today than they were at the height of the mid-2000 bubble. So you have people saying to themselves, wait a minute, I'm not missing out on this gravy train. I thought this was a once-in-a-lifetime thing. I bought the house in 1989. I paid $300,000. Now it's worth $1.8 million again. Maybe I should sell it.
Right. Yeah.
And what's funny is that's what's happening is they had this. One of the reasons home prices rose is there was a lack of inventory. But these rising house prices are now attracting sellers. People are saying, I missed out on the last time. I'm going to put my home on the market and get my money.
Yeah, and a lot of the sellers that I talk to now are one of pretty much. There's 3 different types. The third is basically they're moving because they want to move into a bigger home for their growing family. The first is that they've been stuck in this home since 2004, and they're finally at a point where they can either close to break even and get out of it to move on with their life, right? So those people, and then you just have the people that are just like, I'm at the point where I want to get some cash, so I want to sell this house, but I have to sell it for this price. So it's attracting those sellers that want cash out of their home, because remember, guys, there's only 2 ways to get the cash out of your house. You have to refinance, by either, refinance your first mortgage or taking out a home equity line of credit, or it's selling your home. Those are the only 2 ways to extract. Well, what's happening is many people are unable to qualify for a refinance. So what's the only option left, Louis, when you can't refinance?
I guess that you got to sell. Yeah.
You have to sell. And so when it's impossible to get a loan, it's almost forcing people's hands to have to sell their house. So they
and
sell
who buys them? The people who can get the loans.
Exactly, but then
people
they sell.
Who are cash buyers.
And then they sell their house, and they couldn't qualify for a mortgage before. So then what do? They have to rent. So,
or they can move to another part of the country where they can pay cash for their house.
But how many people actually do that? Right?
There are people. There is a mini trend of people moving from California to Texas. And I know in the Texas metro areas, the home prices are around the national average in the 250 to 400 range, and your average San Francisco Bay Area home is about $1 million. So you could, if you played your cards right, sell your home in San Francisco and move. And there is a trend in people doing that, specifically because of the price of housing, not just the overall cost of living in California, but the cost of housing is a lot cheaper in Texas, and there's no income tax as well.
Yeah, and see, my approach would be, because if you look at what happened the last time, people, they sold their house at the peak, made all this money off their house, they turn around and bought another house, right, where they instantly went negative because the market collapsed.
That's a zero game. They're negative now, that's right.
Exactly. So if you're saying, okay, well, I've seen this happen before, let me try to get ahead of the curve. Let me sell my house, and I'm going to turn around and rent instead of buying another home. I'm going to rent so that I can't lose equity.
It doesn't work in an area where the prices are high, though.
Not at all. And I was about to say, in the D.C. metro area, we have rising rent prices. They're very hard to find rentals.
Well, the person who's renting it to you, remember, has got it in his mind he has to make his mortgage payment and some kind of profit. So chances are of you getting a rental that's cheaper than owning in an expensive area, it's pretty limited.
Yeah, and that's where I think, and this is where I differ from many other agents out there that are, talking things, telling their clients what they should and should not do. But I'm looking at it as, okay, so you cashed out all this money in your house. What I recommend is try to get the most comfortable payment possible without dumping all your cash back into the house, right? You try to get as big of a mortgage as you can at a low fixed rate for 30 years. Because if you can do that and you can still save some of your cash and put that away, then you're in a better position. But don't look at your house as this asset that has to continue to appreciate. Be okay that you're going to hold on to this piece of real estate for however long. But the more important piece is that you've got this mortgage. You have this instrument that you're using to lock in your long-term future home costs, where you don't have to worry about rising rent. You don't have to worry about the landlord coming in and tell you what you can and cannot do.
Right, so you're taking the investment aspect out of home buying and cost of you're including it as a cost of shelter. But it does beg the question in this environment, and we're not giving financial advice here, because I couldn't anyway, because my question is, where would you put your money anyway? Because you can put it in the stock market, but then you run the risk, especially if you've got a nice tidy sum from the sale, that could be wiped in half in a matter of moments.
Yeah,
you can put it in a CD and get less than the rate of inflation and interest, and then have to pay tax on the money that you make. So there's really no safe place to put it, and they've kind of destroyed the safe haven of even putting money into gold and silver, because they got taken down by 35, 50% respectively. So it's very difficult. Even a proper financial advisor, it almost seems like, it used to be the buy and hold mentality made sense, but if you did that from 2000 to today in the NASDAQ, you'd be flat. You wouldn't have made any money. You'd have seen gyrations, big appreciations and big falls, and then big appreciations again, and they're going to have another big fall in the stock market at some time soon. So it is very difficult for the average person. And even the average person who, I wouldn't say gets lucky, but does well enough to have a little money, to not even be able to protect that money without actually actively managing it 24/7.
Yeah, I agree with you.
You got to be all over it.
Not to mention that, it gets to a certain point where, people get frustrated, especially people that are already retired, where they're not making any money in their savings or CDs or whatever it may be, that they then take on more risk than necessary and delve into the stock market, where they have a high risk of losing a lot of money. And I work with a lot of other real estate investors out here now. So I'm even going to give you the flip side. Real estate is still a great place to invest if you understand it. If you're understanding the returns that you can get by buying strategic properties that have good rent, they've had good rent rolls for the last 30 years, and it's not going to change. I mean, there's
making money off your primary residence. You're right. If you can find cash flow properties where you can get rents that exceed your mortgage payments, that's wonderful. But most people are not in a position to be able to do that because, again, you have to have the credit.
Yep. Well, and the interesting part is, Louis, is that, I've worked with a couple other financial firms that are actually, they teach people how to convert their retirement accounts into self-directed IRAs and be able to buy real estate that way with retirement funds, because most people don't have cash in their bank, but they do have retirement accounts, right? They do have these retirement funds. And so I work with a lot of investors that do their own self-directed IRAs where they can manage their own money. They can buy real estate as a passive investment because those investments do have to remain passive, but they buy investment properties. They have cash flow. Some of them 13 to 17 to 18%. I mean, you can't beat that. And I mean, the long term, people always have to have a place to live. Now, if you're buying a rental in a certain strategic area, and you know that it has a proven track record over the last 10 and 20 years, and you've seen consistent rents, and you're in metropolitan areas, really can't go wrong. I do advise that you're making sure that you're working with an agent that understands these things and understands cap rates and understands what you need to look for when buying a real estate investment property. But remember, what we're discussing here is buying an investment property for the investment purpose, not buying a primary residence hoping that your value of your home is going to go up so you can get some cash out of it.
Right.
They're two completely different animals. And I think that almost people have forgotten 6-7 years ago what happened. I mean, it was literally less than 10 years ago, we had that massive destruction of wealth that was created by a low interest rate environment, right? They kept interest rates low for such an extended period of time. It drove prices through the roof. And now, I'm not saying this is going on throughout the country. I'm talking more in the isolated metropolitan areas, like you said, Louis. But I'm hearing, I've got contacts down there in Florida that says there's 3, 4, 5 contracts on stuff in the $300,000 range that are all cash contracts coming in. So it's more, to me, investors that are out there that are chopping up this stuff. And when they realize, like you said, Louis, where else do you put your money? They're realizing, and the hedge funds are realizing, that real estate long term, they're not actually building that many new homes to keep up with the amount of people out there that are looking for housing.
They're at a third of what they were in 2005, 2006 new home starts.
Yeah, I mean, it's honestly crazy. I mean, and the home starts that I've actually seen start up are from those same builders that bought this land, maybe 7, 8, 9 years ago, that they're finally able to turn a small profit now. But they've been sitting for a long time. So it's definitely interesting times right now. But for real estate investors, I mean, I can't feel umpteen calls a week from guys and gals that are looking to get their hands on investment properties that have good rent rolls. Most of them, the majority of the ones that I talk to, they want to hold stuff and they want to rent it out long term. Now, there still is a lot of real estate investors out there that are buying and flipping. To give you, for instance, Louis, in D.C., I mean, you have these row houses, right? These older row houses, maybe built in the 2030s. I mean, they're basically have never been touched. They're selling for $400,000 or $500,000. Investors coming in there, putting $50,000, $60,000 into it, and selling it for $750,000. I mean, that's going on rampant all over D.C. and some of the surrounding Northern Virginia areas, Alexandria, Arlington. Those homes that are very close to the city. There's a lot of that still going on. Now, that's a different type of real estate investment, but because you're basically just going to buy the property, rehab it, turn around and flip it. But once again, all of these things are separate from buying a primary residence, right? All of them.
Here's the thought. When we had the bubble burst in 2005, 2006, after it burst, how did we manage to get back to where we are now? We didn't do it just by low rates. Remember, the rates that we considered low in 2003, 4, and 5 were twice of what they were under quantitative easing. So in order for the recovery, so to speak, to have taken place after the bubble burst, it cost trillions of dollars of Fed intervention. The Fed didn't just set rates low. They actively did something they really never did before on this type of scale. For 4.5 years now, they've been buying trillions of dollars worth of mortgage-backed securities, U.S. Treasuries, based on money that they print out of thin air. If rates get too high now and the real estate market inevitably crashes, what could they possibly do to get rates back down? What could they possibly do to reinflate housing values that people have started to think, Well, that must have been an anomaly what happened in 2005 because really real estate always goes up. It just went up a little too much then, but you see it always comes back. I think this time, though, it won't come back because there won't be a mechanism. You're not going to do triple QE. It's just not going to work at that point. So that's what risk is.
I wouldn't put it past the Fed to turn into not only the lender to banks but the lender to consumers. I mean, that's what would have to happen. You'd have to be able to get loans directly from the Fed at that point because that'd be the only way that they could control what interest rates are given out, right?
The only other thing I can think of is if there's no other buyers for mortgage-backed securities and no other buyers for U.S. Treasuries, and the Fed is still, continues to buy them, they force people to convert their IRAs and 401ks, a certain percentage, into those types of securities. Because there's not going to be the demand if the market collapses for more U.S. Treasuries and mortgage-backed securities. That's why rates will go higher. And the only buyer that can buy in the amounts that are needed would be possibly China, Japan, but they're not going to step up to the plate after another crisis. So the only potential pool of money on that scale would be U.S. retirement accounts.
Yeah, and that's where the biggest amount of money is sitting is in those retirement accounts. And I think it's already started. Because numerous stories have popped up that a lot of government retirement plans they're already a large percentage of their portfolios are buying up treasuries, right?
Well, one of the rationales for that could be very easily is, look, the stock market goes up and down, treasuries are safe. They give you 2 or 3%.
Yep.
And, if it is unfortunate if you're at retirement age to be forced into the stock market to get some type of yield because you cannot afford just to put the money into CDs. But if rates were to go higher and you were to own those, 6-7%, it might not be a bad deal for you. Now, it goes totally against everything I believe in, that somehow they should force you to buy treasuries. But that would be an attractive argument they could make that it's good for the country and it's good for you, just like when you have war bonds.
Yes. So where do you think we would have been if back before the Fed decided to intervene and buy up trillions and trillions of dollars and stuff, if they just didn't do anything? Everybody says that would have been Armageddon. What do you think would have actually happened if they just let the economy fall on its face like it probably should have?
It's interesting because the problem with economics is you can't do A/B testing, and it's all theoretical. On one side, you could say, what would happen if they did nothing? And then on Krugman's side, they'll say, we didn't do enough. What would have happened if we printed 3 times the amount? So it's hard to say. My belief just in economics is that, yes, free markets do create some imbalances, but nowhere near the imbalances you get when you have central planning because there's unintended consequences, there's political motivation, and we've seen with QE that the money has not flown equally to all people. The people that have made money during the QE era, as I would call it, would be the wealthy. It hasn't created a lot of jobs. It hasn't created wealth for the middle class. It's basically created stock market wealth and enabled wealthier people and banks to make money. Now, had banks gone out of business, sure, they would have been hurt if the Fed did nothing. And yes, savers would have been hurt too because they would have lost their money that they had in banks. And if there was now you could have had government intervention where you could have made some of those people whole. But let's just say you allowed the banks to go under and people to go down with them. Well, that would be a great education for people and how they view banks. And what you would have seen, and it would have taken a while in a freer market, is sound banks emerging and touting themselves on the fact that if you want to put your money here, it's safe with us because we don't do derivatives. Here's what we do, and here's how we'll preserve your money. Now, you can go in another free market. There would be banks that would be more risky, and you would get paid a higher rate to take on that bank's risk. But right now, if you look at, people don't shop around for banks. They look for that FDIC sticker, and they say, oh, okay, well, that's fine. I'll put my money there. That's the safest bank. And the bank that's at most risk is Bank of America. It's the largest bank, but it's really at the least risk because you know that bank is the one that's first in line to get bailed out if there's any problem.
Right. Yeah.
So it's hard to say. I would prefer, and no one really wants to allow economic pain because it also creates social disorder and other pains in the society. But long term, you're not doing anyone any favors when you make these central planning decisions that basically reallocate capital in a way that it really otherwise would not have gone. And you only have to point to Solyndra and what's that car company with the electric car that sells at $200 a share, and they sold like 3 of them. These are all things or windmills where the government allocates money to certain areas of the economy that otherwise would not be able to sustain it because somebody has an agenda that they want these types of things to succeed rather than allowing consumers to decide where they want to spend their money.
Yeah, and it's because ultimately the longer that, we keep pushing things down the road, the worse the problem just gets bigger and bigger and bigger versus, having things just kind of let them fall on its face at the beginning. Yeah, we would have. My view is that you would have went through some tough times, depression, whatever you want to call it. But
you never would have gotten there in the first place, though, Ryan. The only reason you had the housing bubble was because you had government intervention in the first place. You had government intervention in the form of keeping the interest rates low. You had government intervention in the form of the Community Reinvestment Act, forcing banks to make loans to people who might have not otherwise been qualified for a loan. So you had that program that Bush had, which was we're going to pay people money so they can pay for the down payment. Those are the things that caused the housing bubble. So if you didn't have that in the first place, you never would have had the problem at such a grand level. But because they created a problem to such a grand level, they're called in to fix the problem that they caused.
Yeah, and really the only people that were taken care of through all that were the big banks. I mean, and then they helped out their friends, they helped out their political guys and everything else.
Bonuses 6 months after the crisis, if you remember.
Yeah. Yeah, I mean it's really crazy. I mean how all things have transpired, and it's every day when you get up and I'm looking at these interest rates, and I'm still trying to figure out how they're so low. And but ultimately, like I said, I mean we're not in control here. The free markets are not at work. The Fed is at work. He's Bernanke is the man behind the curtain, and so we just need to get used to that. We need to.
Yeah, he means well, so to speak. I mean, I don't try to ascribe any conspiracy. I think central planners actually think they're doing good and that they're going to fix stuff that they're totally incapable of fixing. That doesn't stop.
I was about to say, it's an absolute impossibility for them to fix this situation. You know what I mean? There's no way out, and I think they know that there's no way out. So it's just a matter of let's just continue to, switch up our language and the way we say things to try to, appease Wall Street, make, Congress happy, make consumers happy. As long as we have, somewhat of a healthy real estate market, everybody will think that everything is hunky-dory, right? If real estate prices are going down and interest rates are going up, then everybody's going to be like, well, this is the end of the world. So this is the only thing that they feel like they have to hang their hat on, which is sad. But for the most part, like I said, guys, if you're able to, and many people, judging by the mortgage applications, only about 30% are purchase transactions. There's not that many people that are willing and able. Now, in the metro areas, San Francisco, D.C., New York, there's a lot more people that are actually willing and able and qualified to buy homes. So if you're planning on buying between now and the next year, 2, 3 years, you need to start the process now. I always tell people that every time we do this podcast because I see too many people get, a week or two into this process 6 months from now and realize they should have done something today to put themselves in a position to buy, to take advantage of low interest rates. Remember, I'm absolutely thrilled at interest rates sub 5% regardless, just because I understand, long-term implications of inflation, and if you're able to at least protect yourself, your long-term shelter costs at that 5% level or under, I think it's a fantastic deal, and that people that are in a position to do so should do so. And if you can buy investment properties, then buy them, because you're still going to get rates around the 5% level. But if you're not in those positions and you're trying to figure out what you can do to eventually put yourself in that position, I'd be glad to help you out. And if I can't answer any questions, I'll be glad to put you in the right direction to a professional in your state, city, wherever you're out throughout the country that can be of assistance to you. You can check out the website at Real Estate 360 Live. We're in the process of updating it, but on the right-hand side, there's an Ask a Question button. Just put your name and contact information, and we'll get back in touch with you. Like I said, we're giving you all the information that you need. What's taking place in Congress, in the Fed, and Wall Street that's going to affect you and your real estate decisions. And it's not just as simple as hey, housing prices are going up and hopefully interest rates are going to stay low forever. That's just not going to happen. But it is important for you to understand why this stuff is taking place. Louis, do you have any parting thoughts for our listeners?
No, but I think it's going to be interesting to see what the Fed's next move is in order to keep rates low. I think that they will do some form of tapering in September just to prove that, unless something dramatic happens, that they're doing what they're saying, that they are going to unwind because the economy, they'll use that mantra, the economy is getting better. We're in a position where we're able to, we're not perfect, so we're still going to have QE, but it's going to be dropped down to maybe $65 billion a month. And it'll be interesting to see the market's reaction and how well they spin it, because that's the real key, is not what they do, but how it's interpreted. And I think we'll just have to keep an eye on it, Ryan.
Yeah, I think it's definitely something to keep our eye on and pay attention to. And if listeners want to get in touch with you and or want to follow their blog, where can they go to do that?
Okay, so Ryan, you know that I run a blog called Smallgold.com, SMAULGLD. There's a blog, but you can also, from that blog, you can access the YouTube channel, the Twitter feed, and all the other Smallgold content that we produce. And there's also a section with About, which contains my phone number and email address. So if you go to smallgold.com, you can get a daily dose of economics and real estate.
Perfect, Louis. I appreciate all your insights today. We'll be talking to you soon.
Thanks, Ryan. Thanks, everyone.
Thanks, guys. Have a great weekend, and we'll be talking to you soon.